I would like, we start with a small introduction. So if you can introduce yourself, what you do, how you play, in this segment, and maybe on a personal note, anything that you'd like to share with the audience would be great. Yes, please.
Hi everyone, thanks for having me here. Hope everybody had a good lunch. Maybe not too big of a lunch, in case you guys fall asleep. I'm Chuan-Zi, I'm from UBS. I'm after the Apex Strategic Development Lab, and there's two things that I focus on. The first is principal investment. So if there's a fintech company, for example, that we think is strategic for the bank, I'll actually write a ticket to invest into the company if we think that this is something that helps our competitive advantage. The second piece is more broadly new ventures as a whole, and it could be a new venture that is technology related, like digital assets, for example. And interestingly enough, one of the other new ventures that we've built is actually expanding our current public markets brokerage business also into its private equity. So I think this is probably where we have quite a good mix, where both the new ventures that I look after, digital assets as well as private equity, kind of overlaps over here.
Thank you very much. Julian.
Thank you. Hi, everyone. Thanks, Michael and everybody. My name is Julian. I'm one of the co-founders of InvestaX, which is a licensed Singapore security token issuance and trading platform, as well as IXSwap, which is the first automatic market maker for security tokens. IXSwap is built to provide the ability for anyone who issues a digital security or a security token to start the first trading pool, similar to what Uniswap achieved in the crypto space. So it's built agnostic to all the STO platforms, and we believe that 99.9% of the private market assets that will be tokenized won't belong necessarily in an exchange-traded environment. They'll all want some form of liquidity. So currently they're sitting out on OTC boards, waiting for people to come and buy them. And now you can actually create a liquidity pool in a legal, compliant way. And we're headquartered here in Singapore. Thank you.
Thank you, Julian. Benjamin?
Thanks, Daniel. Hi, everyone. My name is Ben. I'm the co-founder and chief commercial officer of Funnel. We are a digital assets marketplace based here in Southeast Asia, offices Singapore, Malaysia, Indonesia, regulated, of course, here. We do have three parts to the business. In a nutshell, we have a part of the business that deals in distribution of securities. We have also a licensed exchange called HG Exchange. That's where we try to tokenize a lot of all these digital securities that we speak about, and also real assets most recently. I can share a little bit more about that later. And lastly, we have a fund management business that deals in secondary transactions. So that also with the intention of obviously driving liquidity on our exchange. The kind of products we do, typical private equity, venture capital, direct investments into private companies, earlier stage companies as well, all the way to growth stage pre-IPOs. So I'd love to talk a little bit more about that later.
Thank you very much, Ben. So the first question that I have for you, Xuan, is to explain us a little bit the difference between market infrastructure, dealing with public instruments and private instruments. I think that there is very often a lot of confusion between the role, the responsibility, and the implication. So if you can give us some lights on how does market infrastructure operate and the key differences.
Yeah, I think to kind of set the context, I think difference between public as well as private kind of assets over here. Well, actually two things, right? One in terms of the asset class, obviously, and the second in terms of the entire front-to-back infrastructure. Public, you've got things like your public equities, your FIX, COMOS, FX, etc. Taking public equities as an example, in Singapore, you've got things like your DBS, your Comfort, Singtel, etc. And then obviously when it comes to the private equity side of things, this would be unlisted instruments. Singapore, for example, you have the likes of your Carousels, your Justcos, Ninjavans, for example, companies that haven't listed before, right? So I think that's probably the first main difference. The second, with regards to the difference between the infrastructure, I think this is quite interesting for us because when we look at public as a whole, the entire front to back from pre-trade, trade to post-trade, is actually quite robust. Pre-trade, you've got your rules of engagement, your code of conduct with how you deal with firm bids, firm offers, indications, etc. So quite well defined. Trading-wise, if a PM at a hedge fund, for example, wants to execute a trade, it's pretty easy. There's a set of decorum that you follow. Obviously, when it comes to its clean settlement, it's quite clear-cut over there too. On the private side, though, it's actually quite different. There isn't that robust set of infrastructure that you have in place. Even things like your pre-trade, how do you go about doing your due diligence? How do you suss out, is the seller even genuine in the first place? Is there provenance of the shares? These are things that problems specific to privates that we don't really see on the public side simply because that infrastructure is not ready. When it comes to us trading or execution, for example, trades take a lot longer to process. When it comes to us post-trade, the way that you handle your roofers, for example, right of first refusals, the way that you negotiate your legal documents, etc., there isn't a well-defined way of doing that, which already exists in the public side because it's so harmonized, it's so commoditized out there. So I think that's probably how we see the difference over there, the asset class as well as the front direct infrastructure.
Thank you very much, Juan. And in that context, we were discussing, Ben, that you also see a lot of complexity in tokenizing those private assets, and maybe more specifically to non-standard assets as the one that you are handling with your platform. Can you give us some views on that?
Yeah, thanks for that, Daniel. And I think I agree a lot with what Chuanji mentioned, right? Like the whole point of having it on the exchange, right? Custodizing those assets is so that as the exchange, you can set those rules, right? And you can say, once it's being custodized and those shares are being traded, you won't trigger those right of first refusals. You don't have to do a long, protracted process of having SPAs negotiated, signed, and executed before shares are transferred, right? It's as simple as a click, right, to buy or to sell. Or that's what we hope, at least. And that's just on traditional assets. And we talk about private company shares, right? Whether you put in an SPV or in a VCC and you tokenize it, right? Talking about non-standard assets, so what we did, sort of more an experiment, right, was real assets like whiskey, wine, art, right? The complexity coming along with that is that not only are these assets, right, in some ways, you think of them, it's one single asset and you're trying to fractionalize it, right? How do you then give investors the confidence that these assets are well maintained, right? That valuations are acceptable and are coming in a timely fashion, right? And lastly, well, obviously they're asking, can we have some form of liquidity, right? And especially if you want to trade it on the exchange, would there be an ability to exit, right? So when it comes to that, it's not a simple, like a solution. There's no panacea to that, right? And each of these challenges, we had to take a bespoke approach, right? So for example, we talk about art, right? We need an independent art manager. For someone who knows the space, who is a thought leader or at least an expert, right? Being able to say, okay, this is how we'll manage it, this is where it'll be physically custodized, right? Not just the tokens, but this is the physical asset in itself, and this is the conditions under which it will be maintained, right? You also need another party to say, okay, independent valuer, right? This is how much it's worth, right? And on a periodic basis, give those updates to investors, right? And lastly, talking about liquidity, right? Can we bring it down to a fraction where I can have, say, institutions, right, like Chuanji come in and say, we're willing to market make, because the quantum is something that, on a risk-adjusted basis, something that's palatable to them and something that they can and are willing to take on balance sheet despite it being non-standard. So these are some of the challenges we face, and one by one, we had to think of innovative solutions to get around them.
Thank you very much, Ben. Now, in terms of market making, because obviously market makers are essential to liquidity. I don't think that we can have, or maybe we can debate about that. We can have liquidity without market makers. On public markets, market makers are there to provide liquidity, but they don't take risk. They have visibility on the value of the assets. They have rating agency, companies that are listed are obliged to provide quarterly reports. So once they have visibility on those assets, then they take a position and they do market making. Can we have liquidity without market making? And Julian, this goes to you. So how do you see and how you see your company, providing a role for the market makers or substituting, to market makers?
Yeah. So we've been in the space as long as anyone, and it's good to see some of the original guys still here and doing really well. Yeah, that's been the number one issue. We've looked at about 1,400 security tokens in the last 4 years, and every single one has an issuer or an investor talking about where's liquidity. I think there was a big misunderstanding that tokenizing, well, put it a different way. If you think about a world of all tokenized funds and startups and millions of different assets, you're never going to have market making for a super majority of them because it just doesn't make any sense. They don't have exchange traded kind of features, characteristics, and there's also going to be too many of them. So what we did, we looked at Uniswap, and most people have heard of Uniswap, but maybe it's just seen as a venue to trade. It's considered a decentralized exchange, but the real innovation of Uniswap was before Uniswap. Let's go back a sec. If you go back to 2008, you buy Bitcoin, you could maybe find a Bitcoin exchange, which was essentially just a listing board, which is what all the STO secondary trading boards look like now. Securitize has it on their front page, actually. Just a listing board. I want to sell this. Then along came the centralized crypto exchanges to provide a liquidity, and everyone went to trade there. And there were order books and matching engines. And that went along for a couple of years to 2018 when Uniswap came along, and Uniswap said, what if we used smart contracts and we allowed anyone who had an altcoin to start a liquidity pool? And with that innovation, anyone who also had the same altcoin could join that liquidity pool, and then we could actually share the market making fees with the people who had staked their tokens, basically. So it's crowdsourced market making. And what that meant was anyone could then start to turn up to Uniswap, and they could buy all these altcoins that had no home before because they weren't big enough to get on Binance. They didn't have $1 million to pay, FTX, whatever it was. So what that meant was the trading volume on Uniswap went from 0 to hero. And that's the real innovation of Uniswap. So we built the same thing for security tokens. Because if you think about millions and millions of STOs, 99.9% of them are going to sit on the OTC platforms of broker-dealers. They don't even have to be in exchanges because it just needs a broker trade. So we built it in the same way. Now, the difference is that you can't have just smart contracts custodizing and trading a security token because it's a security. So with smart contracts plugged into an STO broker, InvestaX plugged into STO custodian, First Digital in Hong Kong, we've launched the first 2 STO pools in the history of the world. And the innovation remains the same in the same light, that for all of the people out here that's dealing in STO platforms and knows that every single issuer comes up and says, this sounds great, I'll do it if there's liquidity. Where's liquidity? You can now turn around and say, you're the liquidity solution. You can start this yourself. So we've taken a design and an innovation from crypto, and we've reverse engineered it back into the security token space. And it doesn't need a market making license because it's not a traditional market maker. It's relying on the broker-dealer and the custody as well as the smart contracts and blockchain. So that's something that we built for ourselves because we've had the same question that's still floating around the whole industry is where's the... And every single STO issuer that I've met thinks they've got the best asset in the world, and there's just magically be a market maker appear out of nowhere to provide all this liquidity for their random asset that no one's ever heard of. And unfortunately, that's not true. But now I think we've got to play here. So of course, over time, exchanges will come more and more. There's a bunch in Singapore. Traditional market makers will turn up. You got this weird situation where traditional market makers don't get the crypto part, but they're getting it, and then you've got all the crypto market makers don't have the license to market make security tokens, so that's working itself out. But now we've come up with a middle ground, which we think is really exciting, and I think it makes a lot of sense for a lot of the assets. A tokenized VC fund, a tokenized startup, that's not an exchange, I guess a small startup, that's not an exchange traded product. So yeah, we think that there's a lot of exciting innovations to come through that, and we'll start to see more people issue now, because if the issuer can start the pool, they've solved their number one problem.
We're going to stay with you in a second. We didn't prepare those questions, so I popped it through my mind. So is this mainly primary or secondary, or do you see a mix of both?
Well, it has to be launched primary, and so it's for secondaries. Yeah, it's for any, just like Uniswap. You turn up with a token that's been launched that has some value, and then you can put it on the platform.
And do you expect that there will be different type of product that are more suitable? Because obviously, if you deal with private assets, it's quite complicated to assess the value. If you deal with debts, maybe easier. So, from your experience or strategic view on this market, do you want to focus on specific type of assets, or you will let the market maker decide what they want to?
Yeah, so it remains agnostic to the asset class. Like Uniswap doesn't care what the tokens do, as long as its contracts are audited and things work. So it's the same for us as well. So it allows, and that's kind of the exciting part. So again, you don't have to beg a centralized security token exchange to put you on there with market and bring a market maker now, which you have to do in crypto, right? If you turn up to, if you have a cryptocurrency and turn up to a cryptocurrency exchange, you have to pay for listings. You have to bring the market making fees. Like, they don't just give you free money. So this is a workaround, really. But also, I think it will be the tail end of STOs in the private markets will be sitting on OTC platforms, not in exchanges. Although there'll be a lot in exchanges as well.
Thank you, Julian. Ben, what is your view on that? Because you deal with another type of assets. We were discussing that you don't necessarily see the role of market makers the same way. So what is your approach to that, and what do you see the market demanding?
Yeah, that's a great question, and I think this provides a really different perspective from where Julian is seated. So from our perspective, because the member firms, right, that are sort of bringing issuers to our exchange, bringing investors to our exchange, they're more traditional, right? So it'd be folks like Phillip Securities, Phillip Capital, Prime Partners. I guess that's Funnel as well. But again, we have to kind of default to their level of comfort. So again, we don't have liquidity pools, but we do have market-making capabilities. But in this case, the format that they're expressing their view, right, it's more a traditional form. So it becomes a question of what are the kind of assets that they'll be comfortable market-making on, and it's about quantum, and it's also about what the bid-ask spreads are, right? Again, if it's too wide, they're not necessarily going to do so. So then the onus is therefore on us, the exchange, right, to be able to do a few things, right? Whenever you look at a wide bid-ask spread, right, or if you look at even the assets that we put on there, right, it requires a few things to be done. The first thing, I think, most importantly, is identifying a product that people actually want to trade, right? Again, if it's just primary issuance, it's just listings, as Julian mentioned, right? Quite a lot of these platforms do that. Really, you're not going to see much secondary market liquidity. I think a function of that is perhaps the fact that it's just indiscriminate listings, right? Just any company, if you're willing to do a few things, you meet the minimum criteria, you're on, right? That's not going to help market making, at least from where we sit. So what happens is then we need to be able to identify products, right? And we need to be able to enter for investors, right? The price point has to be something that makes sense, right? So it can't be an asset that we bring on board that's already overpriced. There's nothing there for them to make anymore. So in the case of what we did with a few of the real assets, we made sure we went to sellers that were selling it, right? I wouldn't say below market price, but because we cut away a lot of the middlemen, right, in identifying these assets, we were able to bring it to market at, for example, just case in point would be the whiskey token. We bought a cask, and a token was about £7,000, right? Today it's trading around £14,000. Between 7 to 14, right? There's a lot of room for market making. And it wasn't like just a one-day pop. There was a gradual appreciation of that price as well. So that's just a case in point. And you know, take away whiskey, right? Can we do that for real estate? Can we do that for a lot of the other asset class? I think, therefore, because of the way they were approaching this, it requires issuers, it requires the member firms as well. It's not just diligence, which people obviously emphasize a lot about, like how do you ascertain that the asset actually exists and it's whatever quality that you state it is. It's more than that, right? It's also about entry prices and valuations. And it's also about providing these investors, right, with information, right, with research reports. So we commissioned a couple of independent research houses to write certain trend pieces or industry pieces about the assets that we're listing, right, whether it's private shares of companies that are unlisted, or so these are late stage growth companies, or it could be some of the real assets that I spoke about. So again, that also helps, right, generate interest and therefore liquidity. Well, again, it's not going to be like what you see in the crypto markets, not going to be like what you see in the public markets, but it's a starting point. And once there is that little bit of traction, the market makers get a little bit more comfortable with taking on that kind of risk.
Thank you, Ben. Now, on the settlement side, and just to come back to that in a second, we obviously have, you know, the trade taking place on infrastructure. Some are making use of the blockchain with new technology, while most of the others are just centralized exchange. In a way, you could argue why you need blockchain for that. Where I see a lot of disruption be coming from the post-trade. Because there, obviously, you know, if you can allow direct settlement once you do the trade, then you are going to create great benefit to the industry and potentially enable a lot of different business models. How do you see those infrastructure today preparing for that? I mentioned, I think earlier, that in Europe we have this regulation, DLT pilot regime, that is defining what is a CST on DLT infrastructure. No, we haven't seen any infrastructure yet. They're working on it. But do you see similar infrastructure being developed in Asia? How do you see that from UBS perspective on potentially using those infrastructure? What are your views on that?
So I think I agree on the points, right? Or maybe if I caveat that, the way that UBS looks at this, we look at it is more from an institutional perspective. So especially when we look at the usage of the technology, across the entire front to back, right, we don't really see, at least from an institutional perspective, much value add from a liquidity standpoint, right? You think about it, if I've got $50 of ByteDance that I'm looking to try to market out, I'm going to pick up my phone, I'm going to call BlackRock, Seganti, one of the hedge funds, for example, and the first question they ask me is, to Ben's point, what's the price? How much discount from the last round, for example? What's the structure? Do we have confidence over the share transfer docs? Have we cited that, etc.? Probably the last question they will ask me is, where exactly is your block of shares? Is it paper-based? Is it a tokenized version of that, right? But for us, where we saw a lot of the value, especially when you compared the characteristics of blockchain as well as that of private equity, is more in the pre-trade and the post-trade component. So we ran a very quick experiment. I think that was 1.5 years ago. Super quick, super technical test. I think completed in 2 weeks. And there were a couple of things that we thought was quite interesting for us. Just the ability to tokenize a share onto the blockchain, and every time that share itself is being transferred, how can we have a record of that on the blockchain? From a provenance standpoint, it's quite important for us, especially when we are trying to suss out, is the seller genuine? Does the seller actually have the provenance of the shares? In a way that public markets are able to do so, but on the private side, we can't have that level of comfort. Even things like, using a smart contract to just enforce certain trading restrictions. SpaceX, no Chinese, no Russians. You can't enter onto the cap table, right? Can a smart contract, for example, be able to enforce those trading restrictions? We've obviously got a huge wealth management franchise, but suitability rules applies, right? So how do we take different suitability rules and use a smart contract and enforce that? Even things like from a clearing mechanism, right? Clearing facilities don't exist, at least in APAC. In the US, there are a couple of guys that potentially have the ability to do so. But in Singapore, in APAC at least, there isn't a clearing facility. So how do you use a smart contract as a escrow, as a quasi-clearing facility to minimize that, settlement risk between the buyers and the sellers? That's generally the way that we've been looking at this. So indirectly, it does affect the liquidity, but it's not a direct function of that. But I would say that most of where we've been looking at is more of pre-trade and post-trade.
Thank you, Shashi. I have a last question before we open to a question from the audience, which is an unprepared one, so feel free to take a moment. We haven't discussed too much during this event, the adoption of public blockchain versus private blockchain. And I was discussing with someone over lunch, and I thought it would be valuable information for you to share. So in Singapore, for example, the regulator is more favoring private blockchain, which could be a very touchy subject. But in Germany, for instance, the German regulators have said that they are not going to assign license to deal with security if they don't operate on a public blockchain that is sufficiently decentralized. Awesome. They made that statement. So you will not go, well, you can do a distribution of candies, if you like, on private chain, but not securities. So do you think that as the thematic of this is liquidity, do you think that working on private blockchain will enable to bring the liquidity to access enough critical mass? And do you think that the MIS in Singapore should be opening up more to public blockchain?
Yeah, look, I'll jump in. I think MAS is super pro public blockchain because so many projects out there. We were part of the first tokenization of the VCC, the new Singapore company, and the project was under a fintech grant to tokenize on a public versus private, see what the pros and the cons were as well. I think fundamentally the whole narrative has changed. So it used to be very heavily, if this conference was done 4 years ago, 99% of people in the audience would have thought it's got to be on a private blockchain and no banks are going to deal with it and the rest of the world, et cetera. There was actually a very big play by 42 banks behind R3 Quarter, this private blockchain, and I don't think it's worked. I think the time has proven. EY, or I think it was EY, put out a research paper last year that said the growth of acceptance from institutions around public protocols use versus private had gone completely reversed. So it was a supermajority now favoring public. The bottom line is very simple. All the digital assets in the world are on public blockchains. Bitcoin, crypto, Ethereum, ICO, NFTs, DAOs. There'll be 10 other things we haven't even heard of that are going to get developed. So building on a private chain works for some. It's fine as more efficiency, but you're disconnected from the entire digital asset space. So we're very pro public blockchains. We've got like 5 integrations. Again, it's a technology layer. So at the end of the day, if it's just technology, what's got the most scalability? And it is not private blockchains.
Ben, your opinion on this?
It's a conundrum, $1 million question. I do agree, Julian. I think the MAS is very open. both ways. I think obviously trying to encourage for institutional participation, there are certain benefits of staying private, a lot more control that they have. But yeah, I think for me, in order for this entire asset class, right, to benefit from liquidity, it is a function of institutional participation and also one big thing, scale. And you can't scale with private, right? But then how do you, so it's a conundrum, like how do you address, right, the concerns of institutional players, but at the same time reap the technological benefits, right, as you mentioned, of going on public blockchain. I do agree we have to go there. It is a work in progress. I think the regulators in Singapore, they're ahead of the curve. Well, at least I'm looking from a regional perspective in other markets that we're in. Having said that, we may have to have that intermediate step where we work with the institutions and get them comfortable and then try to rally, right, all of them to accept and move along with this wave on the public chain. So I'm sure Chandra has some stuff to talk about.
So I think from a bank's perspective, I think no doubt it is true. When we first started, and UBS conducted a lot of experiments in I think 2015, so and so forth, right? Starting first with private because of all the reasons that Ben mentioned, right? Things like privacy, control, KYC, for example. Over time, I think we are starting to reevaluate this position, especially because of the potential distribution capabilities of public blockchain. That said, I think at the end of the day, this layer itself is still a technology layer, but what are the things that's important to a bank that we need to slap onto the technology layer? Things like privacy control, is that something that's only achievable within a private blockchain? Maybe in the past, but right now with all the innovations that's been happening, those are things that you can actually fulfill on the public blockchain. Where we probably draw a line is with regards to things like KYC, which might sound oxymoronic because one of the things about public blockchain is how do you have a wider distribution base, but at the same time you still require the institutions to have comfort about who's the client that you are dealing with at the end of the day. So as long as we can fix it, I think that's not really something that's as long as you're able to have comfort over which is the clients that you're dealing with, I would say that it's not really going to be something that's not surmountable for us. To take a case in point, right? The experiment that we conducted, we did it on private blockchain. For a variety of reasons, right? Private equity is not very liquid. Do I really need that amount of scale when it comes to as private or public blockchain? When it comes to as privacy controls, etc. We were able to do the same thing, but we chose private simply for a couple of reasons, right? One, we had access to that technology. Two, it was quite hard for me to download a MetaMask wallet into the UPS infrastructure. Even harder for me to take some Ethereum and put it into the MetaMask wallet. So that's one of the reasons why we chose private blockchains. But moving forward, when we look at what Singapore has done with Project Guardian, for example, having a public blockchain but with trust anchors on top of that, where the institutions come in and have comfort over the KYC details of the customers, I think that might be one way that we get more comfort around public blockchain.
Yeah, and on a side note, yeah, go ahead.
Could I just add a quick point, right? I think there's one more thing that I hope everyone here can also appreciate, which is perhaps what's limiting us today is it's not necessarily technology. It's not just private-public, right? But for liquidity, how do we get broader participation, right? And at least from where we sit, retail participation is so important. And the gatekeepers of the retail participants, obviously the institutions. So it's a two-step kind of process that we have to go through. How do we get the institutions comfortable? And then how do we open this up to the rest of the retail investing public? And when I say retail, it's not just Singapore, right? How do we then look at synchronicity of regulations, at least in the region, right? Is there a gold standard that we can all follow, right? I mean, you have obviously developments going on in Europe, Switzerland, of course, and then you have Singapore, and then you have the rest of the other countries that are trying to play catch up, right? So I think that's also extremely important. Is technology really what is limiting us? Perhaps maybe not the top problem, at least from our perspective.
Well, actually, from a technology perspective, Tokenize has been developing for 5 years a compliance framework that enables to permission the token on public chain. So it's not the chain that you permission, it's the token, and you link that with identity solutions. So you have indeed that KYC that is being taken care of, and we're promoting that as a standard to create that kind of interoperability between market infrastructure. It's all about critical mass. If you don't have critical mass, you will never have liquidity. So that's the reality of the market.
Yeah, I'm glad I set you up for that question.
So, thank you. So we have 5 minutes left. So I'm sure that you will have a lot of questions in the audience on liquidity and how to achieve liquidity. So who will volunteer? Because I will go random otherwise. So. Here we go.
Thank you. This is for you, Julian. So I think the whole innovation of bringing Uniswap-like smart contract-based liquidity pools to the security tokens, this is definitely a super exciting space right now. How are you going to solve for? And I would have asked this question otherwise to you anyway after this panel. How are you solving for the compliance around it, the KYC? How do you marry the whole openness and ability for anyone to connect to it with the compliance requirements around, AI, KYC?
Yeah, no, that's a great question. And I think that's also ties into the last point where you can create permission offerings using the technology, which I think is a big misunderstanding in some of the institutions, that anyone can access it, an offering. So Uniswap just uses the smart contracts and the two altcoins. So the difference with what we have is we have an STO broker and STO custodian. So the KYC and the AML must be done by a user through those platforms. So again, so it relies on the licensed platforms that have also the technology. And when you come to the platform to create a pool, you send in a security token. It actually goes into the custodian. You had to KYC AML for that to function. So there is, so it's not as fast and as quick as Uniswap with a MetaMask, and that's the end of it, because of the nature of security tokens. But of course, we needed to build it legally and compliantly, because there's a bunch of people that have tried this who have done it without licenses. So, and the same thing for the trade. When the swap's being done, it's actually being swapped off the broker-dealer's license. So the person coming to swap whatever token has to have passed the KYC. So the goal is to get as many STO brokers and custodians all over the world, so you've got all these different assets, and then over time try and work out, I think there seems to be 1 million people working on KYC platforms, but it's still, solutions, but it's still kind of the same. But I think ultimately it can start with a two-step process, and then ultimately IXSwap can integrate with the brokers, the customers, and port that KYC over, so it's basically less clicks. So it's done through the licensed partners. Otherwise, it would unfortunately be illegal. Now, at some point, maybe we don't need those people, and that'll be sort of maybe where the DAOs go and where that jurisdiction lives. But I think we're still in that first phase of how it works out.
And I guess it was a question for me as well. So we have a connector, Comply DeFi, that is linking the on-chain identity with the DeFi protocol. So, and of course, there is no information on the blockchain. Those are anonymous credentials that are just there to ensure that the compliance is respected. So, and I'm not saying that, by the way, we have the solution in the industry, but there are solutions that enable indeed to make sure that even DeFi protocol, you have those compliance requirements that are being taken care of. More question, or are you ready for coffee? Or tea? Okay, well, thank you very much, everyone. Big applause for the panelists.